In this presentation, I want to consider the disadvantages, the drawback, that is, the pitfalls of investing in sector funds. While sector funds offer several benefits, they also come with specific disadvantages we should be aware of. Number one is higher risk and volatility. Because sector funds concentrate investments in a single industry, they are inherently riskier and more volatile than broader, diversified funds. And so, if the sector underperforms due to economic downturn, regulatory changes, or other sector-specific challenges, the fund value could drop significantly because the fund value is tied to the performance of the sector they are invested in. Number two is lack of diversification. Unlike broad-based funds that invest across multiple sectors, sector funds tend to focus on just one area of the economy. And so this lack of diversification increases the potential for greater losses during periods when the sector faces difficulties. And so when this happens, the sector would certainly underperform. So a downturn in a sector can have a larger impact on their portfolio than if your investment were spread across various industries, various sectors, compared to concentrating on a given sector. Number three is sector-specific risk. Sector-specific risk. Sector funds are heavily influenced by the specific risk affecting the sector. This risk can include regulatory changes, technological disruption, fluctuating commodity prices, and other factors that are unique to that sector. For example, a healthcare sector fund may face risk related to changes in healthcare policy by the government or drug pricing regulations. Number four is overexposure to a single market trend. Overexposure to a single market trend. Sector funds can be overly reliant on trends within a single market. While they perform well during periods of growth in the sector, they may also suffer during market corrections or when the trend shifts or when the trend goes against them. So a sector fund that heavily invests in technology, for instance, could underperform if the tech sector experiences a significant decline or a significant a remarkable downturn. Number five is timing the markets. Timing the markets. So investing in sector funds often involve trying to time when a specific sector would outperform. This can be difficult to predict accurately because most investors, in fact, if you could accurately time the market, I think you'll be very, very rich. Few people have the capacity to accurately time the markets. And so mistimed investment can lead to losses, especially if the sector does not perform as expected in the short term. Number 6 is a sector overvaluation. If a sector has become too popular or overhyped, there may be the risk of overvaluation. And if investors rush into a sector based on hype rather than based on the fundamentals of the company in that sector, the sector fund may face significant losses when the market corrects the valuation of the sector concerned. Number 7 is potential for underperformance. There's that potential that the fund might underperform. Sectors often move in and they often they move in and out of favor, depending on the broader economic and market condition. A sector fund that is performing well during an economic cycle might experience decline in the next phase of the economic cycle. And so if that sector is cyclical, kind of cyclical in nature, and for example, the financial sector may perform well during period of economic expansion, but may perform poorly or may suffer during period of recession. Please subscribe to this channel and like this video. Number 8 is or rather number 9. Number 9 is higher expense ratio. Higher expense ratio. And some sector funds may have higher expense ratio compared to broader index funds. Specialized funds with a narrow focus on a specific sector may involve higher management costs, making them less cost effective for long-term investors. In other words, the cost involved will eat into the long-term profit potentials of investors concerned. Number 10 is limited long-term growth potentials. Limited long-term growth potential. Certain sectors may have that slower growth potential, particularly if they are in a mature or saturated industries. This could limit the upside potential of the fund over time, especially compared to more diversified or growth-oriented funds. When you compare what's obtainable here to a more growth-oriented fund, you discover that there could be a level of underperformance, in the long term. There's that limited long-term growth potentials. And so investors should then weigh these disadvantages carefully, especially if they are considering sector funds as a core part, a central part of their investment strategy. So balancing sector funds investment with broader diversification and long-term strategies can help to manage or mitigate this risk. Don't just concentrate on sector funds alone. You can diversify into traditional investing and other long-term strategies as well.